one.
Hello and welcome to Money Matters. I'm Sarah Peterson here with Dean Greenberg of Greenberg Financial Group. How are you today?
I'm doing well. How are you today, Sarah?
I'm always well when I'm with you, aren't I?
We always have fun, don't we?
That's what it's all about. Look, life is short. If you're not having fun, do something else.
Exactly.
That's my motto. Speaking of fun, let's talk about something that's actually not that fun. I want to talk to you today about risk because we are in a world where we have a lot of things already to be afraid of, and it seems like now a lot of people are getting that little edge on them, a little bit of fear factor in the financial sector. And I want you, what you're so good at is taking a little bit of that fear out, because we're going to get educated on why not to be afraid and how to get more confidence in moving forward and planning for our retirement.
Just remember, every time there's fear, there's opportunity. And when the fear comes, it scares people, and it scares people a lot, and the banks are scaring people, and there's good reason to. You know, we've had problems with the banks for different reasons, and if you delve into it, a lot of it had to do with the capitalization of the banks, where it was coming from. A lot of it had to do with the people that were in charge of risk management. But it really stems from inflation is coming, big time. It's continued to stay here, and the only thing that's been able to happen is the Federal Reserve's been able to raise interest rates. The rest of the administration has done nothing. Congress has done nothing. So as you raise interest rates, it's going to affect the banks. My fear is this is just the beginning. In 2008, it was the same way. You had something go on in the spring, and everything fell apart in the fall. Probably not the last of the banks, and not just here in the United States, but moreover. The thing that helps in this plan, when I say there's a positive, what happens with high inflation? You have higher interest rates. Well, a year ago, we didn't have any way to buy good income, fixed income. Well, today you have the ability to buy government bonds. The banks got a lot of phone calls about, what do I do with my money? It's sitting there, it's sitting there. Do you think they're going to collapse? No, I don't think they're going to collapse. What I think, though, is if you have a red flag and the legal limit of being able to be secure is $250,000, I think the onus is on you to do something about that. Because if something happens and you had the time to get out your money over and above the $250,000 and move to another bank or move to government securities or move to annuities or whatever it is that would be able to handle more, then that's on you. And I don't want to bail you out. I get it at the beginning, but I don't get it after the red flag has already been flying.
So how can we avoid pitfalls like that?
Well, if you know it's there, right, take your money out like they did. And I'm not saying you put a run on the bank because that's not what you want to do. But the legal limit, $250,000. So you have to have open. If you want to be in the banks, you open up another account at another bank that has FDIC insurance. But the easiest thing to do is buy government securities. And if you ladder those out, and we'll talk about bond ladders and things like that later, is that you can get a 1 year, 2 year, 3 year, 4 year treasury and probably average somewhere over 4%. I mean, it's an inverted yield curve, so the shorter stuff is paying more than the longer stuff. But the reason you do the longer stuff is because if interest rates start coming down, which they eventually will, then you wouldn't be getting that much income. So that's how you kind of start with it. And the MIGAs, the MIGA annuities, which is multi-year guaranteed annuity, are paying over 5.4% with tax-deferred income. There's many things to do. You have to go talk to someone that understands these things and knows these things. But if you just sit at the bank and say, well, I know something could be a problem, but I'm not going to do anything about it, then that obligation is on you if something happens.
Well, and as we're approaching retirement, we're looking at risk in an entirely different way, correct? I mean, we want to take risk off the closer we get to retirement.
100%. I mean, that's the one thing that people don't realize is that when you're 50 and we have a situation that goes down, you got time for it to come back. But if you're in retirement, you're 65 years old, you've got to be able to mitigate your risk. Because if you don't mitigate your risk, what happens? Markets go down. You wait for opportunities. There's opportunities right now. The opportunity right now is interest rates are higher than where they were a year ago. Mm-hmm. So your cash in the banks, you can do something with. ETFs, you can lock in money for the next couple of years. There's a lot of things you can do to mitigate that risk on the income side, on your safe side, on your protection side. But if you don't know and you just sit there, then how are you going to learn? And the only way you're going to do this is if you have a financial plan and you get to know what your risk tolerance is. The biggest thing about risk right now is everyone's risk tolerance has gone down. We do a thing called Riskalyze, and they come in at, 30, 25, which means, you're taking down a lot of risk. But they all admit it's pretty much because of their fear right now. But fear and emotions should not be your risk tolerance. Your time frame, your assets amounts, the income you're going to need if you're retired or not retired, those are all the things that come into your risk tolerance also.
So that being said, as we're getting closer to retirement, if we're trying to take some of that risk off the table, what is the best timeline for me to start making these plans? For me
Yesterday.
Oh, jeez.
But most people don't, and they're afraid to come and talk about it because they think they haven't done it. No, if you don't start today, when are you going to start? Okay, then start next week. But if you wait a year from now or 2 years from now, it's there. There's an opportunity brewing right now. If we still have more bank problems, if we still have high inflation, if we still have these things, what's going to happen is the markets are going to eventually go down because earnings are going to get less. If markets go down and you're not prepared for that, then how are you going to take advantage of it when they come back up? The one thing I can tell everybody is that the markets will come back at some day. We've had very rare, I've been in this 40 years, twice the markets have been down over two years in a row. Twice. If we go down this year, then not saying we can't go down next year, what happens after that? 2001, 2008, I said, after we get through this decade, the markets are going to have to average a lot more because they always average 10%. The next 10 or 15 years are going to have to be very, very good years. And they were. Why? Because we had liquidity. The Feds were lowering interest rates. On a global basis, everybody was helping. So right now, the opportunity is to prepare for the markets going down. I can't tell you what's going to make them go down, other than earnings, other than the fact that people are pulling back. Inflation means you're not spending. It pretty much is common sense. When it happens, 90% of people will not be prepared to buy. They'll get so scared they won't pull the trigger. That's why you need a financial advisor who's been through the war, who's been through these downturns, who's able to step up and do that. And that's what we do.
Well, and that's exactly what we're offering today. If you have a financial planner or you do not, this is an opportunity for Dean to look over where you're at and tell you, are you on the right path or not? Because if you're not, let's get on the right path.
The financial plan is just not about, this is where you're at. It's also about your tax situation, your Social Security situation, your Medicare situation, your state situation, and it's all about your portfolio analysis. We do it all.
Well, that phone number again is 844-544-4909, or take out that smartphone and scan that QR code. It'll take you right to us. We'll take a quick commercial break, and we'll come back and talk more about how to mitigate risk in planning for retirement.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg of Greenberg Financial Group. And before the break, we were talking about risk, which is a huge topic, but in relation to planning for retirement, there are a lot of risks that we need to look at.
We just talked about market risk. We also talked a little bit about inflation risk. Inflation risk is it eats into what you have. So if you, especially if you're on a set income, set pension, even though you get a COLA, cost of living allowance, it doesn't go up that much. I mean, I just filled up my tank. It was $5.40 a gallon. I mean, I don't know what happened. All of a sudden, we go from the 3s to the 5s already. And that eats into, especially, a set amount of money you get. So if that's happening, guess what's going to happen? People aren't going to spend as much money. They're not going to go out as much. The discretionary money is not going to be there. And the next thing you know, the earnings are going to go down. Earnings go down, valuations go down, markets go down. So there's the market risk. Inflation eats into that. Inflation is a problem because if we don't get we raise interest rates, there's the positive. Make sure you have money so you can invest in those. Going into ETFs, especially the long-term bonds, when these interest rates went up, everybody lost money because they went down. We mitigated that risk. We went ahead and went to short-term bonds, ones that matured in 1 year, 2 years, 3 years. Very important. One of the things that people don't really look at, longevity. You know what I mean? You think and it's hard to think about. You know, how long do you think? But you know your history of health. You know all those things. You get into retirement. People have to understand the one thing that's guaranteed: we're not going to be here forever. And so many people don't make decisions on longevity. Now, if you have people that are living into their 80s, 90s, 100s, and you're 60 years old, there's a good chance you have to do that. So you have to look out longer. And some people don't have to look out that long. So you have to take on the longevity of that you will be around for 25 or 30 more years. Or if you're 75, maybe 15, 20 more years. And that has to come into part with your risk. It really does.
It's interesting to me because there is almost a fear now of longevity. What if I live that long and I can't afford, to live that long? What if I don't have enough saved to live to 100 or 95? And that should be the end goal, right?
If you're not planning when you're 50, 60, and even 70 years old, you got a problem because you could run out of money. The one thing when I sit down, and everyone in my office sits down with people, the one thing we look at is we tell them, and we show them on a chart and how it'll work. If you're sending this much money, and this is the returns you're taking, 4, 5, or 6%, kids can't really look up much higher, this is when you run out of money. If you cut back your spending to this is when you run out of money. And some people look at it and say, oh, I got 15 years and I'm 70. All right, at least I get to 85. Then there's different changes. And I get that, and that's okay, because one of the things is you spend the most money when you first retire. Not the first or second year, but as you get comfortable. It's like a bell curve, and I always look at everything as a bell curve. So when you first retire in those first 10 years is when you're going to spend the most money, depending. If you're at 40, that's a different story, that's a whole different plan. But most people retire in their mid-60s. So if you go 10, 15 years, next thing you know, you're 80 years old. You're not spending as much money as 80 as you were from 65 to 75 to 80 years old. You're just not. And it's evidence investing. That's what I call it, evidence investing. Look at what's happened in the past, look at what happens with people, and invest to correlate with that.
I think the other fear is that people don't spend enough when they start retiring. They don't do the things that they say they're going to do. Oh, I've worked my whole life, I'm going to save up and we're going to do this. And then there's a fear of, I don't know, can I do this? Like, am I able to do this? And what's it all for?
We plan for that too for them. We plan with that, okay? Not everybody is so wealthy they can go do all these big trips. We talk to them. What's your bucket list? What do you want to do? What's important to you? Okay, let's I can pretty much estimate what it's going to cost, all right? Say, okay, so we take that from here, and you want to do that in 2 years. Most people don't want to do it immediately unless they've been saving for it. 2, 3 years because they want to feel comfortable with what they have. Fine, this is still where you're going to be. And if they want to do a little something every year and say, hey, I want 20 grand a year just for vacations, we'll put it into part of the plan. We believe you need to spend that money. There's way too many things that happen that you don't expect. So you want to go ahead and spend it. I'm all about planning your life so you have the income, but living within your income, that budget. But part of that budget, part of that stuff is traveling, if that's what you want to do, or hobbies. I got one of the guys, our clients, trains, miniature trains. He's so great at doing this stuff. And he builds like these model sets of places all over, of going way back. It is the coolest thing I've ever seen. That's his hobby. He loves it. And that's what he spends his money on.
Everybody's priorities are different, but it's just so good to know that if we make a proper plan, we can get from A to B, because that's what all the hard work, blood, sweat, and tears is for. But that being said, longevity being a risk, also healthcare in general is another risk. I mean, rising healthcare costs are astronomical right now.
And that's why people have to look at, do they need care? You know what I mean? Do they need long-term care? And there's some new things out there now. We've been doing some things with annuity products that you're not going to make a lot of money off, but if you don't use the long-term care, guess what? Your money's still there to come back to you. Okay, so it's a combination. I don't like just paying the premiums on long-term care and then you're done. Mm-hmm. Okay, what if you don't use it? You paid all these premiums. So you already owe it, you got the money, put it into this long-term care type of annuity, and what happens is if you need the long-term care, of course, you're going to spend all that money, depending on how long you're there. But if you don't, at least that money is there to be passed on to yourself, or you can take it out if you want later on.
If these types of conversations haven't been had, maybe with your financial advisor when you're sort of in your 30s and 40s, that's probably because this is a different way to plan going into retirement, right? So what we are offering is kind of like a second opinion, just like you would go to a doctor for one. Having an idea, are you on the right path to getting where you want in your retirement? Because the way you look at your finances earlier on in the accumulation phase is very different.
You say second opinions. Yeah, everyone has an opinion. We believe it's a first opinion. Because when they come to us, a lot of people, it's the first time they're ever doing this. All right? And I always ask them why. Well, I didn't know if I needed it. I didn't know if I had enough. I didn't want to hear.
So there's
if I had it.
fear.
Yes. Right. And I said, well, just think if you came 10 years ago, how much you could have planned to be where you want to be, where you are now. And they all agree they should have, but they didn't, because they didn't even know. But in fairness, financial planning 10 years ago, 20 years ago was quite different than it is today. Even the software programs were so geared towards just selling insurance and insurance products and fear, that it's different. Today, it's about your lifestyle. It's about doing the things you want to do and saving money and having income. To me, what financial planning is setting it all up so you have enough income to continue the lifestyle that you want until the day you die.
To me, it translates into peace of mind, which I think everybody could use a little bit of. Just knowing, am I in the right place where I need to be? And if not, how do I get there? And it's so easy. All you need to do is pick up the phone and call 844-544-4909. We even have a nifty little QR code now you can scan and get right to us. The phone lines do get really busy, so please have patience with us. We'll take a quick commercial break. We'll get more into risk when we get back.
When we come back, I want to talk about something that people don't think about, which is a very major risk.
Even I'm baffled. Let's see. We'll see you soon.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Hello, welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg of Greenberg Financial Group. Before break, we were talking about risk, and Dean has something he wants to talk us about, and I don't even know.
There's a risk that happens that nobody wants to talk about.
Oh, no.
Okay? But it happens. The death of a spouse. And a lot of people say, oh, well, that happens, it'll be, I'll be not beneficial that they're not, well, some people might say that, but it's more like, oh, I'll be well off because I got to pay for one. But that's not true, okay? Because now what happens is you only get one Social Security, not two, all right? Probably the higher of the two. But all the things that you were doing together are no longer there. And that death of the spouse, if there's no insurance there, especially if they're doing it and they're still working, that's even more of a problem. And people don't even think about that as part of their planning, you know, or what that person did. And here's the other part. What if it was the woman or the husband, one or the other, that kept all the books, did all the investing, was the one that kept everything going? The other person gets it, they don't know what to do. It's usually one. It's not usually both of them together, okay? A lot of times it's the wife and sometimes it's the husband, or vice versa. It depends whatever their dynamics are. But when that happens and it's the person that hasn't done it, it's a huge loss. And the fear gets even greater and greater. And how you spend the money and what you're gonna do. And you do lose income because you lose the Social Security.
And sometimes, you know, your tax bracket can go the opposite way you think it's going to go.
That was the next thing I was going to say. Your tax bracket now becomes single, no longer married. Deductions go away. So tax planning is very important under those circumstances. Then you then you get the, you know, then you have to get the deceased IRA over to you. And then if you're now you're at a, you know, you put it together. Now you have to have, say, an RMD. Well, your RMD is going to be bigger because it's going to be on you, and single. So there's a lot of things that go into that, that whole thing about planning, the taxes, estate planning. So we talk about that from the beginning. What happens in the estate planning? What can we do in the estate plan to mitigate the risk?
Well, we've talked about this in other shows, but that's, I think, also why it's so incredibly important to have both, you know, spouses in on the planning from the beginning. Because I really feel like for so long, you know, whoever it was, typically it was the woman that was left out of the conversation. And we're most of the times the one left living and having to deal with it. The
other risk is divorce. I can't tell you how many people in their 50s, late 50s, early, are getting divorced. I don't know if it's this pandemic thing or whatever, or they just think, okay, I got to live life and go forward. But I guess it's easier, or people wake up and say, you know what, we shouldn't be here, or whatever, or they find somebody else. But divorce is probably the biggest financial disaster you can experience. You know, think about it. You get cut in half. Well, in Arizona anyway, but so everyone's got half of it, what you got, but it's not the same spending. So it's like a death of a spouse. They have both, but it's not there. If you have life insurance to cover it, and there's different things like that. But estate planning is so important. If you're going through a divorce, you should plan before you get divorced on how to deal with it.
Oh, geez. Well, we're talking about all the happy topics today, aren't we?
Well, it's fear. We got into this thing called fear, but there's positives to the other side if you do the plan.
I think to be motivated by fear is only going to end up in disaster, right? So we've got to take all the fear off the table and go with what what's known.
Okay, so we're in a situation, we have inflation. We have oil, right, going up. Well, oil fell. So now it's going back up. We know at some time it can go higher, right? So there's opportunity possibly in some dividend-paying oil stocks. There's possibility in the ETFs. There's possibilities in interest rates now. There's opportunities. So from an investing point of view, there is. But if you don't plan, you can't get there. You can't throw a dart and say, oh, I'm going to do this or do that. You got to look at the portfolio, analyze it, where you're sitting, how much you have allocated here, how much you have allocated there.
How often do the plans need to be updated? How often are we looking at these and
The portfolio is constantly being updated. The plan, if there's no major changes and you're doing it and it's working, then you don't have to do anything. But if something happens, okay, now you actually retire, or somebody passes, or you inherit money, or all of a sudden you have to help out your children and you need a lump of something. So that's when you end up changing your plan.
Such a personal relationship you have with your clients. You have to know everything, you know, ins and outs of their, you know, kids, family. I mean, it's so important to know all these factors, to know what the right path for them to be on.
I don't want to be in this business and have clients unless I know who they are, what they're about. My first 20 minutes, 30 minutes, we talk about who they are, what they are, you know, and are they happy? Are they not happy? What will make them happy? You know, are they stressed out? You know, we like to talk about it all. I like to know who they are. I mean, it's a personal relationship that you're dealing. Money is very important to people. Health is very important, should be the number one thing. But that's what people fight about, money. And you know what else?
I mean, we're just getting into all the topics today, but health and wealth are so intertwined, and also the two most personal things you can get involved with someone. So to be able to pick up the phone and say, Dean, hey, I'm going through a tough time and we need to talk about it, that's invaluable to me. And somebody who doesn't have a financial advisor, or doesn't have somebody who is helping them on the right path, we all need that. It's really hard to go this alone.
It's an easy process, okay? We've been in Tucson since 1988. You pick up the phone, you come see us. We're on River and Campbell. You get us your information, we talk to you about everything, we get your risk analysis, we sit down with you and go through the plan, okay? Takes about an hour. Then you leave, we analyze everything, come up with something, look for the weaknesses, look for the positives, put a whole plan together, we get together again, we discuss it. You think about it, we tweak it, you tell us we like this, you tell us you like that. I don't like this. I'm not really that scared of everything. You know, my risk tolerance is probably higher. We put the plan together again. We sit down, you say, okay, I'd like to do business with you. And then we open accounts. It's that simple.
Is there anything I can do to be better prepared for a meeting with you?
No, we'll tell you what you need. You know, just don't be afraid of everything. You know, just we'll send you to the stuff that we need to plug into the plan. But here's the best part. When we're done, whether you work with us or not, we send it to you. You get the whole plan. No cost. And if you want to ever look at the plan, or someone else to look at the plan, it's on your computer. You can print it off, and you got all those pages to be able to do whatever you want with them if you don't want to do business with us. And everything went. But we simplify the whole plan down to about 5 or 6 pages of summary. This is what we're doing. This is the idea. This is how much income you're going to get. And this is where we go from here.
This is an individualized, personalized education on you, which who doesn't want that? Other financial advisors charge thousands of dollars for this, and this is complimentary for you for taking the time to sit with us. And thank you so much for listening to Dean and I just talk about pretty much anything and everything that comes to our mind regarding finances, but there's always so much more to learn on every show. We so appreciate you taking
I appreciate you.
Thank you so much. Well, again, that phone number is 844-544-4909. We even have a nifty little QR code you can scan and get right to us, but that complimentary portfolio analysis is for you. So thank you so much for taking the time to be with us, and join us again on your road to retirement. We'll see you soon.